Welcome back to the channel. I'm Algabot, and today we're studying an expert advisor for MetaTrader 5 called Mesa Adaptive Trend Shift. This strategy is built on John Ehlers' Mesa Adaptive Moving Average, better known as MAMA, together with its slower follower, FAMA. It's a trend-following approach that tries to tune itself to the market's own rhythm rather than to a fixed setting. Over the next few minutes, we'll unpack how the indicator works, how the entries and exits are decided, and we'll read the actual code together. As always, this is educational information only, and trading carries real risk. Let's start with the big picture. Mesa Adaptive Trend Shift is a trend-following expert advisor designed for liquid, trend-prone instruments. Think major foreign exchange pairs, metals, and indices, on intraday to swing time frames. The engine runs it on whatever primary time frame you select when you test it. What makes this approach distinct is the indicator at its heart. Most adaptive moving averages, such as FAMA, VIDIA, or FAMA, adjust their smoothing based on amplitude cues, things like an efficiency ratio, recent volatility, or fractal dimension. The Mesa Adaptive Moving Average takes a completely different route. It uses a Hilbert transform quadrature pair and a Hamadine discriminator to measure the market's dominant cycle, and then it adapts its smoothing factor to the rate of change of phase. In plain language, when price rotates quickly through its phase, which tends to happen at a turn, the average speeds up and tracks price closely. When phase drifts slowly, which happens during a clean directional run, the average slows down and glides smoothly. FAMA, the follower, uses half of that smoothing factor, so it trails MAMA like a slower shadow. Together, MAMA and FAMA behave like a self-tuning fast and slow pair. When MAMA sits above FAMA by more than a volatility band, the strategy reads that as an uptrend. When MAMA sits below FAMA by more than that band, it reads a downtrend. The volatility band is scaled by the average true range, and it adds hysteresis, a deliberate buffer that keeps the strategy from reacting to the noise where the two lines simply kiss and cross back. This approach is suited to traders who prefer a systematic, rules-based method and who want to study how cycle-based adaptation behaves. It is not a promise of any particular outcome. It's a framework for learning. Now let's walk through the mechanics step by step. The expert advisor works on closed bars only. Every time a new bar forms, it takes the just closed candle, feeds its high and low into the Mesa engine, and advances all of the internal cycle calculations by one step. From that update, it produces two values: MAMA, the faster adaptive average, and FAMA, its slower follower. Before any trading begins, the strategy waits for a warm-up period, at least 60 bars, so the cycle measurement and the moving averages have time to stabilize, and so the average true range is fully available. The ATR period defaults to 14. Once it's warmed up, the decision is straightforward. The strategy measures the gap, which is simply MAMA minus FAMA. It then builds a separation band equal to the parameter SepAtrMult, which defaults to 0.15, multiplied by the current ATR. This is the volatility-scaled buffer. If the gap rises above that band, the strategy sets its regime to long. If the gap falls below the negative of that band, it sets the regime to short. And here's the important part. If the gap is inside the band, that narrow neutral zone where the two lines are close together, the strategy simply holds whatever regime it was already in. That's the hysteresis, and it's what prevents the system from flip-flopping on tiny wiggles. Trades happen only on a genuine regime flip. When the regime turns from anything to long, the strategy closes any open short position and, if it isn't already long, opens a new long. When the regime turns to short, it closes any open long and opens a new short. So the system is always trend-aligned and never holds two opposing positions. Every trade is framed with risk controls derived from ATR. On a long, the stop-loss is placed below entry by SlMult times ATR, a default of 2 times ATR, and the take-profit is placed above entry by TpMult times ATR, a default of 3 times ATR. On a short, those distances mirror to the other side. With the default settings, that's a reward-to-risk ratio of 1.5 to 1. The average true range adapts these distances to current volatility, so the stop and target breathe with the market instead of staying fixed. Let's read the code as it appears in Meta Editor. At the top are the input parameters. FastLimit and SlowLimit set the upper and lower bounds on the adaptive smoothing factor. SepAtrMult, defaulting to 0.15, controls the width of the ATR hysteresis band. ATR period is 14. SlMult and TpMult at 2 and 3 set the stop-loss and take-profit distances as multiples of ATR. Lots is the fixed position size. Below the inputs is the regime decision. The code computes the gap between MAMA and FAMA and a separation value equal to SepAtrMult times ATR. If the gap is above that separation, the new state becomes 1, meaning long. If it's below the negative separation, the state becomes -1, meaning short. The two Boolean flags, flip long and flip short, are true only when the state has actually changed direction. That's what makes this act on a fresh flip rather than every bar. Now the buy block. When flip long is true and we're not already long, the strategy reads the ask price as its entry, sets the stop loss below entry by SlMult times ATR, sets the take profit above entry by TpMult times ATR, and calls trade.buy. The sell block mirrors it exactly. When flip short is true and we're not already short, it reads the bid price, places the stop loss above entry, places the take profit below entry, and calls trade.sell. Both sides use the same ATR-scaled risk framing. Let's bring it to life on the chart. On screen you can see the price candles, and drawn right over them are our two adaptive averages. The gold line is MAMA, the faster average, and the blue line is FAMA, its slower shadow. Watch how they interact, because the crossings between these two lines are the whole story. Look at the first few candles on the left. Price is drifting lower, making a series of lower closes, and notice that the gold MAMA line sits below the blue FAMA line. That tells us the strategy is currently reading a downtrend regime. MAMA is beneath FAMA, so there's no reason to be long. Now watch the third candle. Price puts in a lower low but then reverses sharply and closes near the top of its range. This is exactly the kind of fast rotation the Mesa engine is built to detect. Because price is turning quickly, MAMA's smoothing speeds up, and the gold line lifts and crosses above the blue FAMA line. And critically, it doesn't just touch it. The gap opens wider than the ATR separation band, clearing the hysteresis buffer. That confirms a genuine regime flip to long, and the buy entry marker appears. The expert advisor closes any short it was holding and opens a fresh long. At the same moment, the stop loss is set below entry at 2 times ATR, and the take profit is projected above entry at 3 times ATR. That's the reward to risk ratio of 1.5 to 1 we discussed. From there, follow the run. Candles 4, 5, 6, and 7 each close higher. And notice how the gold MAMA line stays cleanly above the blue FAMA line, with the gap holding wide. This is the strategy's ideal state. A clean directional move where the adaptive average glides rather than chops. On the 7th candle, price reaches up into the take profit target and the long trade closes for a gain in this illustration. That's the complete long cycle. A fast turn confirmed by the crossover, a smooth trend, and an exit at the ATR-based target. Now the market rolls over. On the 8th candle, price opens near its highs but closes sharply lower, a bearish reversal candle. Just as before, this rapid rotation speeds MAMA up, and the gold line dives down through the blue FAMA line. The gap opens to the downside beyond the separation band, confirming a flip to a downtrend regime. The sell entry marker appears. The strategy opens a short, sets the stop loss above entry at 2 times ATR, and projects the take profit below entry at 3 times ATR. Follow the decline through candles 9, 10, 11, and 12. Each one closes lower, and the gold MAMA line stays firmly below the blue FAMA line the entire way down. The regime is holding short, and the hysteresis band keeps the strategy in the trade even through the small pauses. On the 12th candle, price presses down into the take profit target, and the short closes in this example. So across this sequence you've seen both sides of the strategy. A long taken when MAMA crossed above FAMA by more than the band, and a short taken when MAMA crossed below FAMA by more than the band, each one framed by an ATR stop and target. The crossings you see between the gold and blue lines are the adaptive averages retuning themselves to the market cycle. And that is the core idea of Mesa Adaptive Trend Shift. That brings us to the end of our look at Mesa Adaptive Trend Shift. We covered how Ehlers' Mesa Adaptive Moving Average measures the market's dominant cycle and adapts its smoothing to the rate of change of phase, how MAMA and FAMA act as a self-tuning fast and slow pair, and how an ATR-scaled hysteresis band filters the crossovers so the strategy acts only on genuine regime flips. We also read the code and walked a full long and short example on the chart. Remember, everything here is educational information only and not financial advice, a recommendation, or a solicitation. Trading involves real risk, and losses do occur. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.